Hello and welcome to another episode of the Student Loan Planner Podcast. Today I've got our senior consultant, Lauryn Williams, joining us. Lauryn, how's it going?
It is going wonderful. It's been a long time no talk, Trav, but I'm excited to be doing another pod with you.
Yeah, me too. We're going to be talking about taxes right now, so people better buckle up because it's going to get crazy.
Don't stop listening. This is going to be a really good episode.
Before we get into that, I thought we would make it a little bit more interesting and start off talking about Little Olympics. So for those people that don't know, you are one of the very few athletes to medal in both the Summer and the Winter Olympic Games. I guess can we just hear that story about how you became a Winter Olympian just randomly? I think it's one of the funniest stories ever.
Yes, the winter athletes are over there competing in Beijing, China. So make sure you tune in and support Team USA. But my story for being a Winter Olympian kind of hinges on kind of being in the right place at the right time. So I was in the airport, headed to a race because I was doing track and field still. And I ran into another girl who also had participated in bobsled. And I was like, hey, I read an article about you trying bobsled. How was that? Was it cool? And I was just trying to create conversation. Little did I know she was going to be like, this is awesome, Lauryn. You should try it. You actually have all the tools you need. You're a very powerful athlete. I think you should sign up. And 6 months later, I was at the Olympic Games in Sochi, Russia.
That is crazy.
Yeah.
That's really crazy. So how many people did you have to beat?
Probably about 12 in totality. And we kind of whittled it down to 6. And then of the 6, then there were 3. And yeah, I got to race as the USA 1 sled, which means that was the sled that was expected to do the best. And we did. We were the highest USA sled, and we got silver only by I think it was 0.01 of a second. It was a very close margin. Yeah.
Who was first?
Canada, Kaylee Humphreys, who's now an American. So you also should root for her, even though she beat our butts the last time, because she's going to be on the winning side this time.
Yeah, oh my gosh, that's pretty funny. So we engage in that kind of hunting for athletes too, that these other countries do, right? Like the dual citizen kind of thing.
Well, there's a whole big soap opera that we won't get into about how she became an American athlete, but it was basically that things weren't going so great over there in Canada. And so she was like, I'm going to get over here on this side. So
that's funny. So how do you feel about watching this? In terms of all the quarantines and the stuff that the athletes are having to go through, how do you feel like the experience would have been different if you had been, having to go through that yourself?
Oh boy, I cannot imagine being an athlete competing right now. I mean, the mental toughness that it takes in order to prepare yourself for an Olympic Games, to avoid distractions, to stay in the zone and actually make the most of the moment and the opportunity is already next level. And then to add the hoops that you have to jump through from a COVID standpoint, not having your family nearby to be able to support you. I mean, we talk about mental importance of mental health. I think that it is going to be key that they have proper sports therapists over there. The girl that I raced with, Alana Myers-Taylor, is actually in quarantine right now in China, hoping to get out in time to compete because she got a positive test for COVID. So can you imagine being in China with COVID, in isolation at the Olympic Games? And there's a possibility you're going to get out and be able to compete, but you're also exercising in isolation and not actually really being able to properly prepare.
Was she the one that was on the Today Show or something like that was supposed to carry the torch for the Team USA?
Exactly. She had been chosen to be the flag bearer and couldn't do it because she had COVID.
Oh my goodness.
Yeah.
Oh my gosh. That's crazy.
Mm-hmm.
Yeah. I mean, I remember when she was being interviewed, they were like, can I get something to exercise with? And they brought her an exercise bike. And it's okay, so you've got this world-class athlete in this tiny space, and all she's got to keep her muscles in performance shape is an exercise bike. Oh my gosh.
And it's a power sport. And she's a driver, that's the other thing is for me, I was the person that pushed the bobsled. So I'm kind of like the Flintstone feet to get the engine going. So it would have been important for me as well to be able to stay fresh and, stay powerful. But for her, she's got to be able to drive the sled in order to learn the track, to understand the physics of everything. She learns by doing. She needs those reps right now.
People were also talking about how all the ice and snow is sort of this weird manufactured kind of thing. And I guess people said that you used to get to go check it out kind of and test the track out a little bit. But the Olympians only got to do that a couple of weeks ago because of COVID. Is that the case? Were you able to go to Sochi kind of early to sort of get practice runs in?
Yeah, there were multiple practice runs as an opportunity. Well, we didn't actually go to, actually, I joined so late. I missed Sochi. That's what happened. There were practice runs pre me where other people got to go over. But yeah, we did go into Sochi about a month in advance and, get acclimated and figure out what was going on and what we could expect. And then there's also a certain amount of practice runs you get to do right before the games.
Yeah, wow. So watch the Olympics to support Team USA is your takeaway message.
Yes, exactly. We need your support. Every member of Team USA, they need your pleasant tweets. They need your pleasant, Instagram posts. They really need to be pumped up. Imagine being in a foreign country in isolation right now and then add on the biggest stage ever to compete against the whole world. Definitely want to send positive vibes their way.
That's good. It's good. Well, let's send some positive vibes to our listeners about taxes. Because everybody could use some of those.
Yes.
So first off, let's talk about income-based repayment recertifications for people. November 2022, if you're after that date, kind of get ready. But if you're before that date, it's kicked out to 2023. Could you give maybe like some examples of like the kind of questions people are asking about that right now? Maybe just kind of explain that in like layman's terms about what they're doing with like IDR recertifications right now.
Oh, for sure. So we're getting this question all the time. And so one thing I want to clarify is that, when you can recertify is different than your annual recertification date. So if you recertify every year in June, that will be your recertification date. And while you may recertify your income, let's say right now, that may be a possibility, you want to be very strategic about how you go about that. And so let's stick with June as the date, June of 2022. You're automatically going to be kicked over to June of 2023. And that's because the rule states that no one needs to recertify their income until November of 2022. So everybody that is pre-November of 2022, no need to recertify. Like I said, is there a possibility for you to do it? Yes, but it could further complicate your situation and it could result in you having a higher payment than you would have. And imagine if you've been not paying your loan since March of 2020, you're using your 2019 tax return. In May, when it's time to start paying your loans again, you're going to be using possibly that 2019 tax return if you've done no recertifications. So it's very important to be strategic and understand when you need to recertify and what is in your best interest as it pertains to being most cost effective. And that would be waiting in this example. June of 2022 now gives you all the way until June of 2023 before you need to recertify.
That's a good summary. So like basically some people will need their 21 returns and some people won't, right?
Exactly.
Yeah. So like, let's think about that. So, if you're doing June as your recertification date and you were supposed to be June 2022 and now you're June 2023, well, by June 2023, you'll have your 2022 return filed. So in that example, you would basically have your 21 return become irrelevant, right? So if you were going to file separately, you were going to have to pay a penalty for that. Maybe you would file your 21 return joint to get that money where you don't have to lose it. Then maybe you'd file 2022 separate. But, what if you had a case where somebody was, a November 2022 recertification date? Well, that would be 2021 that you would have to use the tax return for. So you would need that 21 return. Like you said too, Lauryn, people can recertify early. So if your income went down or maybe it stayed about the same, maybe you're like a public servant that hasn't gotten a raise in forever and the raise you did get this year was tiny. Maybe you recertify for that reason because, the poverty line went up a lot this year because of inflation. So some people that have unchanged incomes might even want to recertify. So there's all kinds of strategy involved with this. So these recertifications, so I know we're going to be getting a lot more questions about this for the next several months, right, Lauryn?
We have definitely already been getting quite a few. And like you said, with tax season upon us, a lot of people are wondering like, wait, should I do joint? Should I do separate? So if you're in that boat, you definitely want to get to the bottom of it because it is not a one size fits all strategy.
Yeah. So that's like some IDR recertification talk. Let's talk more generically about how people can save money on taxes. So like employees, actually, I guess everybody would qualify for this one. So charity, you can do $300 as a charitable deduction if you're single or $600 if you're married this year because of the CARES Act. And that's usually not the case. So Lauryn, I guess, the standard deduction is what most people take, right? Like, why do most people take the standard deduction?
Because they don't have a lot of other things to be able to deduct. So if you're a normal W-2 employee, maybe you don't own a home, you don't have a lot of kind of complication to your life, then you take the standard deduction and that kind of lowers your overall initial income. But what happens is, and previously you needed to be above the standard deduction in charitable contributions in order to get something. Well, that's actually currently the rule. However, this cool thing that you're talking about, Trav, is that everyone is eligible to deduct $300 if they're single or $600 if they're married, independent of what the standard deduction is.
Right. So, I mean, if we think about like that deduction, what does it mean? Like a lot of people give money to charity, but it's like not a ton, right? Like if you're making $50,000 a year, you might give like a couple $100 to charity or $1,000 to charity over the course of a year. Usually that's just like out of the goodness of your heart because you're not deducting that, right?
Exactly.
But this year is kind of unique. This year you can deduct $300 as a single person or $600 as a married couple if you made a donation to charity this year, which is kind of cool. And that's something that's worth, $100 to $200 probably for a lot of people right off the bat. So that's one little quick way to not miss out on that little tax return for your taxes this year. It's probably not going to be there in the future. So 401ks like 403bs, 457s, Lauryn, how can people save money on taxes by contributing to those?
Oh, this is something we talk about all the time in our consultations because it also lowers what we call your adjusted gross income, which is relevant for your student loans. But the short of it is that if you're contributing to a pre-tax account, such as a 401k, a 403b, or a 457, you can put up to $20,500 in for 2022. And if you were in 2021 and we're talking about the previous tax season, it was $19,500. So one thing I always like to clarify is there's the match and there's the max. So often I hear people saying, yeah, of course, I'm doing the match. My employer puts in 3% and I'm putting in 3%, and they think that's it. They think they're doing everything they can as it relates to their employer retirement plan. However, the maximum is $20,500. So if we just kind of do some quick math, someone makes $100,000 a year. If you're just putting 3% in, you're putting $3,000, and maybe your employer is also doing $3,000. Well, that's $6,000 total. You're asking a lot of that $6,000 to grow to enough to help you live a $97,000 lifestyle. So you definitely want to make sure you're doing a lot to be able to save. And because one, saving is going to get you ready for retirement. But two, this is our tax episode, it's going to save you money on taxes. So you put that $20,000 in this $100,000 situation, brings your income down to $80,000. So now you're paying Uncle Sam based on $80,000 of income. That $20,000 was money you got to keep for yourself. And from a student loan perspective, your student loan payment is going to be calculated based on that $80,000 of income. So you get a threefold benefit by really prioritizing putting money away on a pre-tax basis.
So it's kind of like a triple tax deduction up front. Like you get federal, state, and the student loans, which is just a really big deal. 401k, 403b, we kind of have like the 40 something category, 40 something category. And then there's, so you do, the maximum contribution to that is what you're allowed to go up to. And then you have 457s, right? And then there's 457s that are like through universities, which are generally maybe not as good. And there's ones through governments, which are better, in my opinion, because you can roll over the 457 government plan into your own, IRA at some point, which is kind of nice. Now, you might not want to do that because with 457s, you can pull out that money and not pay penalty taxes. So, it's a lot of different financial planning reasons that you would want to look at these more carefully than what we're talking about quickly on a podcast. But, just know that your 40 somethings through employers, you can either do the max for one of them, or you can even maybe contribute the max to like a 403b and a 457. But you can't go back in time and do that. So whatever you did in 2021 for those is set. You can only change the future for those accounts. But, if you did make contributions, you definitely want to make sure that those are reported correctly. Make sure that, you get credit for those when you're entering your information in on your W-2.
Yeah. Super duper important. And I would also say too, that it's really important to be thinking about the idea that, like you said, these are strategies that cut the light bulb on for you here by hearing them in the podcast, but that you may need to do some additional digging to find out what's appropriate based on your situation. Another thing that we always talk about from a lowering your adjusted gross income standpoint or saving yourself money on taxes is the HSA. So if you're single, you can do $3,600 on an annual basis into your HSA, which is a health savings account. And if you're married, up to $7,200. So another good way to be able to save money. You want to explain how that works, Trav?
Yeah, it's like the only triple tax advantaged account that exists. So it's like a traditional and a Roth like combined. So you can put money in pre-tax, it can grow pre-tax, and then you can pull it out without paying tax as long as you use it for qualified medical expenses. What financial planners tell you to do is put money in there and then pay your medical expenses like out of pocket so that you can let that money grow. And then in retirement, it's grown tax-free for like decades. And then you pull it out tax-free at retirement when it's worth a lot more. So think about it like, you've got a little HSA chest, right? And you put money in the chest and you could pull it out and use it, or you could let it in there, stay in there and just compound and grow. And that's probably a better way to use an HSA. The one thing I've learned about all this though, Lauryn, is that like sometimes people get a little too excited about all the different accounts when you just really have to worry about just doing a good enough job. And so what I mean by that is what you said earlier about the match versus the max. Oh my gosh, I'd be so wealthy if I had a dime for every time somebody got those confused. You know what I mean? Like people are like, I thought, and the other big one is, well, they told me I couldn't put money into my 401k, or I'm not eligible for my 401k yet for 5 years or something like that. Generally, you're always eligible to contribute to your employer's retirement plan. You just might not get a match yet. That's a big misconception. Like it was like that way for my first job. They didn't give me a match for the first year, but nothing stopped me from contributing immediately. I just had to make the conscious decision to sign up. So I signed up and, contributed the max in the first year of employment because I knew you could do that. But a lot of people don't know that. So that's the big thing I'd say, Lauryn, that people need to hear is the match is not the same thing as the max.
And so one other thing that always comes when as I think about this, Trav, is the idea that, well, my employer's not giving me anything, so I'm not going to contribute. And that's absolutely the wrong mindset. If your employer never does a match, that does not mean that you are off the hook for saving for your own retirement. And so this is still a really cool vehicle for you to be able to put some money away because we are on the hook for someday we will either not want to work anymore or we will physically not be able to work anymore. And your employer, not giving you a little bit of extra money does not let you off the hook for putting money into this retirement plan. And so save yourself some money on taxes, choose, whichever one is available to you, figure out your budget. It will result in you bringing home a little bit less on a monthly basis by contributing to these, but you will be getting yourself, like I said, this money is for you. So you're going to be getting yourself on track for retirement. And the last thing I'll say about the 401k stuff is that we're saying 401k, 403b, 457. Sometimes people see the Roth in front of it and they're like, oh, Lauryn said 401k. And it's not the Roth 401k, not the Roth 403b or the Roth 457. You need those words without the word Roth in front of them for all the tax benefits that Travis and I were just talking about. The Roth, it does a completely different thing. And I think this is actually a really good transition into talking about the Roth IRA and then the idea of this backdoor Roth IRA, which is all the rave as well. Trav, tell us a little bit about that.
Well, I have to say confession first, Lauryn.
Uh-oh.
I messed up how to use an HSA and I messed up how to use a Roth IRA. So I want to just fess up here publicly in front of our listener audience and tell people that I have committed the financial sin of not using those adequately. So, let me explain. So my wife had the option to sign up for an HSA, or she could sign up for the plan that was more expensive that would allow her to go to the doctor or whatever she wanted for like a small copay, right? This was in her first job out of training as a physician. And so I said, well, we have to do the HSA plan because we could hit our out-of-pocket max. And if we did, the cost would be the exact same as paying the premiums in the more expensive plan. So in other words, it was like a free option. It was like heads, I pay the same thing just through my HSA instead of through the more expensive plan, right? And tails, if we have a healthy year, then we got an extra $7,000 of wealth that we were putting away, right? Mm-hmm. That's not how my wife saw it, though. My wife said, so you don't want me to go to the doctor if I need to? and we had a fight about it. And it was like so stupid. It was like one of these, stupid fights that married couples have. And it was just like, she's like, fine, I'll pick the health savings account, but, I'm going to go to the doctor whenever I want. And I was like, well, that's the point. Like I'm in favor of that too. Like,
Right.
so anyways, I fought so hard for the HSA, but the thing is that shows you the reason why like financial planning is math plus emotion, right? It's because we're not like computers. We're not sitting here punching out like how to optimize our accounts to 1,000%, right? Like my wife felt like she preferred health insurance that like made her feel like she could go to the doctor whenever she wanted without having to feel like she would get a bill for $1,000 that I'd have to go pay. And then that's kind of what happened is we got all these bills. We hit our out-of-pocket max. I think we got, a gazillion like different sized bills, which was annoying. Like it was like one for 20 and one for 50 and one for 1,000, right? And this is the year we had a baby, and it was fine. I just remember like getting all of those bills and having to pay all of them and just keeping track of it all. And then the stupid health system that we were using, they had one like a physician's group and then a hospital group. And so we would always get like two separate billing accounts we had to log into to pay instead of one. And so it was just a big old mess. And then the best part about it was we had this health savings account money, Lauren, and we let it sit in the bank the past 5 years. We left it in the bank because it was such a pain in the what to sign up for the self-directed brokerage account option because they used like HSA Bank, and HSA Bank, in my opinion, was a real pain in the ass to use. And just trying to figure out how to go on and set up the investing option so the money could be invested. It was like they intentionally didn't want you to invest it for some reason. I guess because most people don't think about using the HSA optimally. They use it to reimburse their health expenses that year. And furthermore, I reimbursed some health expenses in the first year that we had it to try to kind of partly because I wanted to show my wife like, hey, look, we can just use the HSA for its intended purpose. And if we empty it and because we hit that out-of-pocket max, fine. And so, we had debit cards. We were using the debit cards initially. Well, guess what, Lauren? I didn't report all of the different things that we did on my tax return that year. So the IRS audited me for it.
Oh,
not a full audit, not like a straight up audit. That was not what they did. They just sent me a piece of mail that's like, we think you owe this amount of, 2,000 extra in taxes or whatever it was. But I will say, I think the HSA thing is not what triggered it. It was like that I had some income that was paid to me personally that I reported incorrectly through the business because I didn't know what I was doing at that time. And so that was just, when you trigger the system, it triggers everything. And so anything that was off, they asked about. So I had to go back and file like the form for the health savings account to like prove that I had the deductions that I said I did, which is just, I just did screenshots and it was fine. And they said, just kidding, you don't owe anything. There's no penalties because no taxes were owed. So it worked out. And I finally just made a new HSA at Fidelity and submitted the paperwork to roll these accounts over, Lauren. But I had one of them, I was able to transfer over electronically, but then the other one, they required like a paper snail mail form to request rollover for it. And so once it's at Fidelity, we'll have like 10 or 20,000 or something, or maybe 20,000 in an HSA at Fidelity, and we'll be able to finally invest it, Lauren. And so finally that'll grow tax-free. And so maybe it'll double 2 or 3 times until we're 60. And so maybe we'll have $100K tax-free that we can use at retirement. But was that worth the marital stress and the gnashing of teeth with forms online and like getting audited by the IRS and all these things to save, instead of paying no money in taxes, I would have had to pay, let's say 40% on that. So I would have lost 40,000, 30 years from now. Was it worth it? Probably not.
Probably not.
So I want to say that just to make people feel a little bit better about their own situation. If you don't have an HSA, I'm sorry, but it's not the end of the world. You're doing just fine. If you can't contribute to a backdoor Roth, I didn't explain that. The backdoor Roth, I didn't contribute to it simply because I hadn't gotten around to it. It wasn't because I was like not wanting to do it. I just like hadn't taken the time to sit down and do the conversion, like open it, put the money in the after-tax traditional IRA, roll it over immediately by converting it to a Roth immediately after the contribution. And I did that for both of us, but it was the kind of thing where I just put it off because I was doing other things like brokerage accounts, trying to chase my 1-year-old around, stuff kind of gets in the way and you don't do it. And so that's one reason to have a financial planner is because they can help keep you on track. It's kind of like a personal trainer or something. They're going to kind of force you to do the exercises. Like that's one benefit of a financial planner. But the other thing is if your savings rate is good, all these accounts are just tools in the toolbox. I don't know what a good analogy is, but it'd be kind of like I don't know, having a whole forest full of lumber that you need or something, and you've got some tools that you can use to cut it up or something, you got plenty. You're good. It doesn't matter if you have like the right kind of saw when you have one that's good enough.
Mhm.
That's a weird analogy, I guess. I'm thinking about that because we're chopping firewood all the time. But it's just the thing. Like if you have a brokerage account and you put money into that, and you have your 40 something, and you put a lot of money into that, most people are going to be just fine. And so don't stress out if like you don't have the Roth or you don't have the HSA, because like, honestly, I could be dead a year sooner, Lauren, just because I just messed up that HSA so badly. Then it's $40,000 for a year of life. It wasn't a fair trade.
Yes, you are exactly right in how sometimes people get a little bit overwhelmed by I'm not optimizing every little piece of this. When really, ultimately, what you need to do is like, no, am I on track for retirement based on what my goals are? And is my savings rate appropriate? The where is not as important as are you doing it? Are you taking this action? I will say that the where can't be like a savings account. Otherwise, you're probably shooting yourself in the foot. But definitely, the benefit of a financial planner would be, like you said, somebody that can like oversee this, who's doing it all day long. Like this is literally what I spent my morning on with my clients: is who needs a backdoor Roth? Okay, here's the process, and you're just, I'm clicking the button, so I'm doing it for everyone, and so it makes it a lot easier to be able to get those things taken care of versus you having to spend an hour on the weekend to be like, wait a minute, what do I do again? Traditional IRA? Okay, move it over here. And, if you're making a nice hourly wage, it's like, how much of my time could I have spent been doing something else that earned me money, as opposed to doing this thing that, was a time suck and frustrating and overwhelming and probably didn't earn me that much.
And the good news is that financial planners, they don't have to put them on a ship and ship them across the Pacific Ocean. Like you can just hire one, in the sense that like I'm waiting on my flooring right now. It's been like 6 months, and the manufacturer just keeps being like, "Oh, we'll get around to it. We'll get around to it." Man, I mean, like, people are professionals really busy right now, right? But at least like good financial planners, you don't have to get like a bunch of supply chain stuff shipped together to get someone's service, right? I mean, it's just kind of crazy. So like a backdoor Roth, just to briefly talk about that, basically that's pretty straightforward if you wanted to do that on your own, unless if you have like some traditional IRA money, like that's pre-tax sitting there, right? Or like any kind of like pre-tax IRA money, converting with a backdoor Roth can like kind of mess stuff up a little bit, because I think that they include some of the pro rata share of that IRA in the conversion, which can cause you to pay some extra taxes. Am I getting that right, roughly, Lauren?
You got it right. And I see it happen all the time. You definitely want to be careful if you have a traditional IRA sitting outside of, what I usually recommend is rolling that traditional IRA into your employer 401k or employer retirement plan, as long as they allow it. That way, everything's nice and clean and you don't have that pro rata thing to worry about.
Well, that's one of the benefits of something we'll talk about in a second, but just the 401k aspect of things. It's kind of like IRAs are easier, but 401ks are more powerful. Like that's kind of, at least my opinion. If you have all the money in the pre-tax 401k, that you can do the backdoor Roth, and there isn't, that pro rata conversion share of, in terms of having to pay extra taxes with the backdoor Roth. So backdoor Roth's great, HSA is great, but don't freak out if you don't have them. Just do a good job of knowing the difference between what a match on a 401k is and a max on a 401k is, right? That's really the message we would want an employee to hear. So, you can also do a couple other things. You can look at mortgage interest, you can look at state income taxes, you can look at property taxes. But after the 2017 tax reform, your typical, even like middle class or upper middle class professionals probably gonna use the standard deduction, I think, right?
Mm-hmm.
I mean, wouldn't probably most of your clients probably take the standard deduction?
Yep, most of them still take the standard deduction. Like I said, you got to be pretty big givers. I think is usually the thing that kind of tips people over, or like you said, homeowners that have significant interest deductions there, even though it's capped. Between that and the other things, like such as a charitable contributions or something, that might tip them over the edge. But it's pretty hard now.
Right. So let's talk about some self-employed stuff, like some business owner stuff. So
Yeah, we just gave a lot of love to the employees and talked a lot about employer retirement plans. But like, what if I don't have one of those because I am an entrepreneur? What do I do then?
yeah, well, then I just, let's just hope you're withholding enough taxes to not have that be a problem. So, so that's one thing, is just make sure you're paying your taxes, estimates correctly. But in terms of saving money in taxes, so let's talk about like a sole proprietor, versus an S corp, Lauren. So like if you're a sole proprietor, you're just like, you got a bank account and all the money is coming into your own personal bank account, probably, right? You probably didn't hire a lawyer to set anything up, right? You're probably just like, maybe you've got like a flower shop and you just, all the money just hits your own personal bank account. You pay all the expenses out of your personal bank account, and that's legal, right? So like, how does that work with somebody's a sole proprietor? Like, how do their taxes work?
Yeah, like you said, what you make is in fact your earnings, and your business expenses can be deducted, but it is all happening in one area. You are not a separate entity. A lot of times people are operating as sole proprietors. They may have something like a DBA, which means you're doing business as like Jane's Flower Shop. So you didn't set up a whole big business entity. But, when people call, they say, hey, I'm looking for Jane's Flower Shop. They don't say, hey, is Jane there, per se. And so you definitely want to be mindful that being a sole proprietor is different than, being a business entity set up in some of the other fashions that we'll talk about in just a second. But essentially, when you are a sole proprietor, the money that you earn is your income, and you will be taxed as if that was your income. And so you need to be accounting for it in some way. And also, as Travis said, setting some taxes aside as well.
Yeah, I think a lot of the threshold is sort of like, how much money are you making? That kind of like determines a lot of the tax strategy. So if you're making 40 or 50,000, let's say you're a chiropractor and your profit's like 40 or 50,000, maybe it won't make a ton of sense to pay 2 or 3,000 for a tax professional to set you up as an S corp LLC and try to save some money on that regard, because maybe the savings just won't be that big. So, you just do the sole proprietorship and just have yourself just, kind of not a separate entity like you're saying. And maybe that's just easier for you. I will say that when I became an S corp for student loan planner, I didn't know what I was doing. I was a little scared. Like, I was a little confused about what was going on. And basically what the CPA said is like, okay, you set up an LLC, and then your LLC can be taxed different ways. So you can have it taxed as an S corp, or you can have it taxed as a C corp, or you can have it taxed, different ways. So your LLC is like the thing you go get the agreement from, like on like LegalZoom or from an actual attorney, and like that's your business. And then you can take that LLC, like articles of organization, and go open a bank account for your business. So you basically take that down to the bank and you just say, hey, can I open a bank account up for this business? And then like you said, it's a separate entity, right? So your S corp LLC is like a separate entity. And so now maybe you're making, let's say the flower shop, instead of making 50,000, let's say it's bringing in, 200,000, because it's really killing it. Valentine's Day is coming up, or maybe already will happen after, once this is released, right? But, it's, let's say she's just killing, making a ton of money. Well, she could maybe pay herself a wage out of that S corp and take the rest as a Schedule K, like profit distribution. And, why would you do that? Well, a couple reasons would be, one would be eliminating, lowering your self-employment tax. You have to pay Medicare and Social Security tax, and that eats up 15% of your earnings. Well, if you're an S corp, sometimes you can set your wage lower and avoid that tax, which is totally legal if you do it the way an accountant would do it. Sometimes you have to set what's called a reasonable wage for your services. So if you're making 200,000 as a flower shop owner, maybe your reasonable wage for a manager is 60,000. And so since the, Social Security wages cap is maybe around, like, what is it, 120 or 130? I don't remember, Lauren, but something around there. So you avoid paying, that 15% self-employment tax on all but 60K of income, which saves you thousands in taxes. So that's one thing that you can do. A lot of dental professionals that work at multiple offices, they are often 1099, and then they'll often tell me their tax person set them up as a corporation. 95% of those people are S corp LLCs, right? Where people, they set up the LLC, they set up the S corp, and so then they take a lower wage so that they can take, profit distributions from their business, which is just their own, dental professional services that they're providing, right? That saves them money on taxes, which is mostly coming from avoiding self-employment tax. But there are other things now too. So like there's that 20% of profit deduction. Have you come across any clients that have benefited from that, the 20% profit deduction for S Corps?
Oh, the EBIT, is that right? Yeah, EB. What are the letters?
It's complicated, right? I think it's like
Right.
199A deduction, I think. And I think it's like, up to 300K or something like that of income. You can take it and it can lower your taxable income by 20% of your profit or something. And it's limited to 50% of wages. It's kind of complicated. And that's if you provide any kind of services. If you provide like professional services, there's the cap and how much you can deduct. And so there's all this complicated aspects of taxes is basically what we're saying here, right?
For sure. Yeah.
So it's super complicated. So maybe let's take a step back for a second. Just say if you're making over 100,000 net income and you are self-employed, you need a tax person, almost surely. At least let's say it this way. A competent tax person would very likely pay for themselves. And there's, great ways to find them is just going on Google search and looking for reviews. That's how I found my first tax person. And then, I moved and had a different state tax attorney. I got really confused. So I just went and leveled up to somebody that did larger businesses that worked in my state so we could close out all the old stuff and open up all the new stuff, right? So find somebody that can fix the stuff that you need the most. But one thing you need is retirement accounts. And so let's talk about just like a SEP IRA and a solo 401k for self-employed people just at a basic level.
Yeah, so the Sep Ira and the solo 401k are going to be those pre-tax options we were referring to when we were talking about employees. The Sep Ira is going to save you money on taxes if you make contributions to it. However, you're going to be limited to 25% of your net earnings from self-employment. So there's a bit of a strategy there in doing that calculation. The solo 401k, on the other hand, is going to allow you to put in that same $20,500, assuming that you've earned at least that much as the employee. But because you're self-employed, you're also the employer. And so you're going to be limited to that 25% number as the employer. So you're going to be able to get more money into the 401k than you would the Sep IRA, assuming that, like I said, your overall earnings are high enough. And so in 2021, that number was 58,000. So we talked about that max versus match. There is no match because you are the employee and the employer, but there is a maximum, and it's much larger when you're thinking about this as from a self-employed standpoint. The whole amount that you can get into one of these retirement accounts is $58,000 last year, and it's gone up to $61,000 in 2022. So a huge savings opportunity. Huge opportunity to be able to get yourself on track for retirement, lower your adjusted gross income, lower your student loan payment, because this is the Student Loan Planner podcast, and be in really, really good shape overall from a tax perspective because you're rerouting a lot of your income to something that's going to benefit you a lot more than it's going to benefit Uncle Sam. One thing I would like to say about this, though, is as we think about from a student loan strategy, is the idea is definitely to get your income low if we're talking about going for taxable forgiveness, but you don't want to do so at the expense of you cheating on your taxes. And so what we get all the time, Travis was just talking about the idea that when you're an S Corp, you're going to pay yourself a salary. So some people are like, oh, I'm just going to pay myself $1,000 a year. And even though I'm making $300,000 a year, I'm going to turn that into the student loan people. And that's going to be my income. And I'm never going to pay on my student loans ever. Bad strategy. One, because of that reasonable compensation aspect of things. And two, because it's not actually honest. So Trav, do you want to talk a little bit about the idea of like not cheating on your taxes when you're self-employed and using the strategy that we hear about so often?
Like the Republicans in the Senate actually put forward a plan once that would basically be like pay as you earn, but it would only be based on wages. And so it would just be part of like payroll where it would just be automatically deducted from your payroll. And what's funny is I think they had no idea what they were talking about because I don't think they realized like how much more generous that would have been for like so many of our clients. Because, in general, Republicans are a little bit more like against like student loan forgiveness and having the taxpayer overall like pay for things like that, right? And I say taxpayer, obviously student loan borrowers are taxpayers too. How much of that do you want on the individual versus on the tax system, right? But it was funny because they were saying like, oh yeah, like people can just pay it through their payroll and they can do 10% of their income for 20 years. I was like, did they realize what they would do, what people would do? Everybody would come in S Corp. Everybody would pay themselves a low wage. and everybody would pay 10% of some super low wage, right? But that's not the current rule, like you said, right? That's what everybody dreams of it being, but it's not the current rule, which is that, an S Corp salary has to be reasonable. So you can't, like you said, pay yourself $1,000. The IRS would audit you and probably say you owe a bunch of penalties or something, so you have to pay yourself a reasonable wage. And typically for S Corps, people are intentionally trying to make that look low, because you save more money on taxes the lower you say your wage is. Now, in some cases, you also want the wage to be high, like for a solo 401k, for example. So a solo 401k is what I have had for a while, where you can put in the $20,500 for 2022, and you can do an employer match, but you can only do that if you don't have employees. So because I think a lot of the people in the student loan planner team prefer to have flexibility and options over their own retirement savings, I think a lot of people have their own SEP IRAs or solo 401ks. And so that's how we've been able to do it for our company, at least. But if you have employees, then the SEP IRA, the solo 401k options, you can't really do that, because the idea is that you would have to offer something like that to all of your employees. And then you would be, putting in just a massive match that just wouldn't be economical if you had employees. So, these are great options if you're like a 1099 endodontist that works at several different offices, but they're not good options probably if you're a dentist practice owner that has employees, right? So if you're a dentist practice owner, you probably need to set up your own 401k, and you probably also need to look at doing like profit sharing and maybe hire a professional to review that for you. But it is funny, like you say, Lauren, like everybody dreams of just like, oh, I only pay myself like, 30,000. It's funny too to see the range of like potential fraud that people share with us. We're not saying that it is, because we're not tax professionals, so we can never call something that. But I will say it's funny to hear like the tax person who's like very conservative, who told them to pay themselves this, and then the tax person that was like taking it to the max, like being like, oh yeah, like this dentist can earn like $40,000. It's like, what?
Right. Yeah, slightly extraordinary. Don't do things that are fraudulent. Don't break the rules. Understand the rules. The other thing that we talked about this LLC and this S Corp, is that people just make the assumption that because they are a business, they need an LLC, and that simply by getting an LLC, they're going to save money on taxes. That is not actually how it works. So an LLC, once again, is an entity. That is a way of being set up, and it's going to limit your liability. That's, in fact, the term LLC, limited liability. However, you can make a tax election, which is this S Corp that Travis and I have been talking about. So you choose to take the S election status, which is a tax status, which you take with the IRS, which now allows you to be taxed in the way that we've been talking about, where you pay yourself a wage and there's distributions, et cetera. The actual LLC in and of itself, by simply being an LLC, does not save you money on taxes. So that is one thing to be mindful of as you kind of go through this process, because we hear that all the time as well.
That's a great point. I mean, like I got confused about this, like, because I'm not an attorney, and it was really confusing to me for the longest time. And when somebody explained it this way, it made a lot of sense. That basically they said that you have a legal status and then you have a tax status. And those are two separate things, although they can be the same. So, for example, your legal status might be a corporation, might be an LLC, might be a partnership, and that's governed according to like a bunch of rules. If you're like a single person LLC, a single member LLC that owns the whole thing, then it's real easy. You can just use some sort of, form letter or something that you get an LLC with, and then you can go open a bank account. And you might say, well, what's the point of that? Well, if you have a separate bank account that's owned by the LLC, when you get sued, somebody can come after you, but they are going to be limited to the assets that the LLC owns. So that's the reason why, it's helpful to have the LLC stuff. Now, from a tax perspective, you look at that LLC and you're like, well, how do I get that money? Well, that's why people set up S corporations, because you can get access to the money basically whenever you want. You just set up a wage, and then you can take profit distributions whenever you want. And maybe you have the LLC, and maybe your goal is to be a big company. And then so maybe if you're making seven figures, maybe you set it up like more complicated way. Maybe you set it up as a C corporation, which is easier to do for like investment purposes or something like that. So there's just all these different options that people can have. And this is, like we say it with student loans. Like if you've got 20,000 of student loans, like go use our refi links and get a low rate and pay it back. You probably don't need a complicated student loan plan. But, if you have 100,000 or 150 or 300,000 of student loans, and you're married or you're a business owner, there's all these things going on. That's why people hire us, because it's really complicated. So the same thing I think is kind of true for taxes. So if you're like W-2 only, what would you tell somebody about doing their taxes? If you're just like, all you make is W-2 income and that's it, what would somebody do?
I think it's okay. What I usually recommend for my clients is that you still work with an accountant every other year. And the reason I suggest every other year is because generally an accountant that you work with is going to look at your previous year's return. So you're going to be able to get a look at whatever you chose to do on your own. If you, self prepared, or if you use like a TurboTax or some other automated system, you can prepare those taxes and then they can catch anything that you might have made a mistake on. So you kind of get those extra eyes from a professional on them. But I would still try to work with a tax preparer of some sort. Well, not preparer. Let me say specifically, I recommend that you work with an enrolled agent or a CPA. Those are the two people that have gone through a certain amount of education, taken an exam, they have continuing education, and they can also represent you in court should you be audited. A tax preparer, Travis and I can decide today, hey, we're tax preparers. We can go online, get a thing called a TIN number and start doing taxes. Like, we could probably do your taxes okay. We got some financial expertise, but do you really want someone who's not doing this all day, every day, filing your taxes for you? My answer would be, not so much. So I would say it's okay to be a W-2 income earner. One of the narratives out there is just like, oh, woe is me. I don't have any write-offs because I'm just a regular employee. I don't have a house. I'm wasting money on rent. I'm not getting all the write-offs that everyone else is getting. I would say to be more focused on some of the things that we talked about on the top half of the show, and then decide, like I said, how you want to prepare your taxes, but be prudent in thinking about the idea that it's okay to do your taxes on your own, but you probably want to get an extra set of eyes on them just to make sure that you are actually taking advantage of all the tax things that are available to you.
Yeah, I mean, I would say that it wouldn't be that hard to pay somebody annually for it. I mean, it's like a few $100 probably at worst if you're just W-2 only. You're paying more than you need to, but it's not that big of a deal. And maybe the tax person throws out some pieces of advice that might occasionally save you way more money than that. I would probably say work with somebody, I would say every year, or you can also do free file pretty easily. So Lauren, there's this website that kind of gave me a heart attack because some of our consultants were recommending it. I think it's called turbotaxsuccess.net. So I'll say that. And if we're not supposed to say it, our editor will bleep it for me. But that's what the website name is. I'm not saying an inappropriate thing. This is just literally the name of the website. And they have a bunch of free file resources that post links to the federally required free filing option. So actually, like, for the right to market, tax filing services to taxpayers, the federal government requires tax preparers to have a free filing option. A lot of people don't know this. And all you have to do is just put in your W-2 and submit it. And a lot of people that have super simple taxes could actually do that. But a lot of people pay for that premium software that they don't even need. And so that's kind of interesting. So I wish they chose a more safe for work URL than that, personally, because again, when I saw that in a client summary from one of our consultants, I was just about to have a panic attack. I was, what are they recommending? Quality,
It wasn't me.
Quality control. What's going on? So, I mean, what I would suggest instead is just type in TurboTax sucks free file. So that's a more appropriate, I guess, word, or whatever. Just make up some negative thing to say about TurboTax and then type in free file, and you'll probably find a place to file your taxes for free if you're just W-2. If you're just a brokerage account owner, if you maybe have W-2 income and you got a little brokerage account at Robinhood or something, or Vanguard, you'll get something called the 1099 div, and that's where you can report your earnings from your investment taxes. Any bank accounts, 1099 INT will report your interest income. So what you can do if you have brokerage accounts, you just buy TurboTax and you just upload, you'll be able to log in, to any of your accounts where you have investments or savings or whatever, and it'll upload your files for you, which is kind of nice. So then you could still do your own taxes if you wanted to. But, anything, in my opinion, Lauren, if you're self-employed or if you're making over $100,000 a year, I tend to say just get a tax person because it just makes it easier.
Amen to that. There is strength in hiring a professional, and I mean, just even peace of mind in hiring a professional to handle these things. You're awesome at what you do, whether you're a vet, a lawyer, a doctor, a teacher out there listening. you are an expert at that thing. And so let someone else be an expert at this lane. This is not where you want to cut corners to save a couple bucks. And you might actually be costing yourself thousands and not even know it.
Well, sometimes too, you can hire somebody where they at least pay for themselves. So for, a small business owner, you're probably going to almost pay for the fee of most reasonable tax people by having them set you up that LLC S Corp thing for you. So that's pretty good. Like that's pretty helpful to have. And, even if you are paying for a service, well, at least you're not having to do it and worry about it. I think parents probably got a ton of white hair trying to do their own taxes properly every year. Like I remember Lauryn, I had them buy like the Vanguard Total International Stock Fund. That was a huge mistake. Not so much for the fact that it underperformed the U.S. markets the past 10 years because you couldn't have predicted that, but because they issue a little bit of like foreign income, I think, because it owns so many stocks from around the world. And there's a sort of like a foreign tax credit, like part of TurboTax. The idea is that if your companies pay taxes overseas, then you get a credit for that in the U.S. where you should get to pay like less taxes on your income on that mutual fund. And so you just have to fill out this basic foreign tax credit like worksheet in TurboTax where you would like assign it to, I think it's called a registered investment company, which is basically like a mutual fund. And it's not terrible if you know what you're doing, right? But Lauryn, I made such the mistake recommending this fund to the parents because they said, "You're making me do this foreign tax credit worksheet. And I'm so confused and I'm so mad about it. Why do we have all this foreign income anyway? Isn't U.S. income good enough?" Pretty funny. So it's not that hard. Like you just have to be patient. And if you're not patient, like very few people in my family are very patient, then maybe stick to U.S. only investing, and stick to easy stuff that you could just, don't worry about, but I think taxes are a thing where you can save a lot if you get good help. I will say, Lauryn, our tax kind of partner that we advertise sometimes on here is full, doesn't have any room for this tax season. So I would just say if you probably Google search is a good option, looking for good reviews, people that understand like whatever you're going through specifically. So maybe that's like for Lauryn, my first hiring of a CPA, I hired them mainly because there was a local income tax in St. Louis. And it was the worst thing from a tax perspective that I've ever encountered.
Oh, no.
Not because it was expensive, because it was just freaking confusing. You had to file like a wages form and then like a profits form, and you had to submit it all to the right place. And it was just like I got more forms that I had to file, I think, for the city of St. Louis than I did for my like state and federal taxes. Like it was just really well, that's a little bit of an exaggeration, but it was just really confusing. And so I hired, this person that was really good for kind of handling the city hall whenever they had like an income tax question. And my life got so much less stressful. I was like, this is worth its weight in gold, to like, and I feel like too, one year, I think I got like an audit request from like the city government. And my CPA was like, "Well, I'll fix that." So I'm exaggerating here, by the way. I think we did submit everything formally we had to submit, but he was just like, let me call so-and-so in accounting and we'll settle that, It's like, I thought that's not how it works. Like, you don't just be like, "We want an audit." You're like, no, it doesn't work like that. Like in the federal government, right? Like, but that's the kind of benefit to get a tax person, is if whatever painful thing it is, be it, figuring out LLC rules or figuring out if you qualify for that 199A deduction or figuring out what your right number to multiply the 25% is to get your SEP IRA contribution you can make, whatever that stuff is, it's going to be a lot easier with a tax person.
For sure. And if you want to continue just avoiding all the things you don't want to deal with, you can move to a state where there's no state income tax, like Texas or Florida. I think there's like Nevada. There's a few others out there, but yeah, if what Travis said scared you, just come move to Texas with me.
There you go. I mean, yeah. Or North Carolina, you could just turn yourself into a corporation because in 10 years, supposedly in North Carolina, no corporation will pay any income tax.
Wow.
So maybe I'll just turn myself into Travis Hornsby Incorporated. I'm just kidding. I don't think you can do that. But, again, run it by your tax professional. So, folks, if you need help with your student loans and navigating taxes, navigating tax filing season, that's one of our busy times. So, busy times generally are like the grace periods expire for people's student loans. people graduate and then tax season, are some of our busiest times, right? So, and, the tax stuff, there's all these things to consider. Do I file joint? Do I file separate? There's huge implications to this, right, Lauren? So they should go to studentloanplanner.com/book. So studentloanplanner.com/book. You can reserve up to 60 days in advance right now is what we're allowing people to do because their calendar isn't in great shape right now because a lot of people are booking plans, which is a good thing, but it makes us less available. So Lauren, what would you say to somebody that's unsure about getting a plan from one of the consultant team?
I would say the time is now. Your peace of mind is so important. And if you're losing sleep over your student loans, you're losing sleep over the idea that they're going to kick back in May. You've had this really nice reprieve, but you're like, what am I going to do? And you just want to make sure that you're on the right track. There's 6 different consultants. Actually, we're up to a team of 8 at this point. And so there's 8 people who are doing this all the time. We're knee deep in student loan stuff so that you don't have to be knee deep in it. And in 60 minutes, you can have clarity. You get 6 months of email support. Like, I think it is by far one of the best things you can do for peace of mind moving forward.
Yeah. And the other nice thing about having 8 people now is somebody brings up something they saw in a really complicated consult. And it's not just that person that's accountable for it. It's all of us. Lauren, when we're debating a case or something, like people will post it in Slack and like we'll talk about the details of like a particular case and we'll bring it up in our consultant meeting that we do every couple weeks. And that allows us to use all of our brains in coming up with like the right solution for someone. And sometimes when we can't figure it out, we have other experts that we reach out to, tax people, legal people, where we really try to go through the most thorough process of delivering student loan advice of any group out there. And, even if you run into a one-person shop or something like that gives good student loan advice, that's good, but it's probably not going to be as good as a team of people all working together to try to get the best result for you. So like a lot of people are like, oh, well, I booked with Travis, but I want to work with Lauren, or I want to work with Rob, or I want to work with, Megan, but I booked with Travis or so, whatever, like all these different things. But just know that like when you get a plan from Student Loan Planner, it's a whole team approach to advice, even when it's one person delivering the plan.
Right, exactly. And when you put more heads together, you get lots more information, lots more knowledge, and a lot higher probability that you're going to have the best and most efficient answer specifically for you. So I really appreciate that idea. Is like, with the PSLF waiver is one of the things that has had us all kind of on our toes constantly. But to be able to bounce an idea off of one of you guys and say, hey, this is what I was thinking for this client as it pertains to this waiver. Is this your interpretation of the language? And know that we're getting, like you said, the best answer for the client has been just something that even takes a load of stress off of me, because you're right. I want to do the best thing for you. I want to do what is exactly right for your particular situation. But these answers sometimes are a little bit gray. And like I said, it's not one size fits all as it pertains to student loan planning. So the fact that we are a team and that we can support one another in making sure that we give great advice has been awesome.
Yeah, definitely. Well, Lauren, thank you so much, folks. studentloanplanner.com/book. And remember that the Federal Reserve is raising interest rates at least a couple times this year. So if you need to refinance, you can go to studentloanplanner.com/refi. So that's all we've got for today, folks. Thank you so much.